Defence contractors. I'll be speaking to the CEO of Babcock International. Also ahead, Sky News understands ministers have rebuffed pleas for financial support from a UK electric battery manufacturer, which is on the brink of collapse. And how more businesses are looking to entice over 55-year-olds to return to the workplace. Good afternoon, this is Business Live with me, Ian King. Now, it's been a tough few years for the defence contractor Babcock. The company, which manages the Royal Navy's base at Devonport and helps maintain the UK's nuclear submarine fleet, has suffered a number of accounting problems and had to write down the profitability of a number of contracts. The latest of these came yesterday when the company took a £100 million hit on its contract to build Type 31 frigates for the Royal Navy. Chief Executive David Lockwood, though, insists the underlying picture is improving.
Type 31 is a great vessel and has already sold internationally, even though we've yet to complete the first UK ship. Strong pipeline of growth. So the first thing to do before we talk about the specifics is to say this is still a great business to be in. On the contract specific we have here, there are a number of external influences on cost. And we are in a debate with government about to whose account those costs should fall.
Now, you operate across 4 different areas: marine, nuclear, land and aviation. They all seem to be growing at differing paces. Where for you is the main action right now?
There's actually action in all 4 of them. They obviously move at different pace. The land domain can move very quickly. People can choose to refit vehicles, to mobilise vehicles very quickly. Whereas obviously ships are bigger and therefore take longer. But the underlying growth in all 4 looks very strong.
Obviously not so very long ago, there were a lot of concerns in the defence sector that access to capital might become a problem as investors focused on ESG, environmental, social and governance. To what extent has that changed since the war in Ukraine?
So I don't think that people who have previously removed themselves from investing in defence have yet returned. And I think that is still a concern. But I think the pressure on people who are active in our sector has now been removed as people learn to understand that we need to defend our democratic principles in order to have ESG at all.
It's very interesting. I mean, some countries have obviously raised their defence spending as a share of GDP, but it feels from the outside looking in as though there is a lot more to come on that front. Is that your sense?
I think there is more to come, but I also believe that we have a part to play as industry in delivering that capability and performance that people need at an affordable price.
Looking at the mix in your business now, you're 68% defence, 32% civil. Do you see that shifting even more deeply towards defence over coming months and years?
I think over time it will, but I think that we get a lot of useful technologies and useful innovation from the non-defence part, so I wouldn't want to lose it completely.
And obviously, in terms of nuclear, decommissioning old reactors is your forte, your specialism. But are there any opportunities presenting themselves potentially from new nuclear build in this country? I'm thinking now particularly the government's committing to small modular reactors.
So as you rightly say, we are a major player across all aspects of nuclear in the civil world, whether it is build, operate or decommission. So we're already a build partner with EDF for the current construction. We're a partner with Rolls-Royce for their small modular reactor, and also we have a deal with a company called X-Energy who do even smaller reactors for generating hydrogen. So yes, I see lots of opportunity for us.
There seems to be a bit of a debate as to whether small modular reactors are actually going to take off in this country. Are you pretty confident that they will?
To be honest, from a market perspective, we look at it as a global market, not a national market. You need a global footprint, I think, to make the economics work.
Quite so, and you actually have been winning big decommissioning contracts in other jurisdictions around the world, most notably Japan recently.
Yeah, and I think it's a good example of us working with the UK government to deliver something which matters for the world at large by being involved in that Japanese decommissioning. So UK industry, UK government doing something good.
What about aviation? I mean, it's the smallest part of the business right now. It's also the least profitable in terms of margins. Do you have an uphill struggle to improve the profitability of that particular part of the business?
Historically, I don't think we've given it as much attention as the other parts. We do some fantastic work in pilot training. We do it in the Ascent program in the UK. We do it in France. That often takes place in joint ventures and therefore doesn't get reported in head margins, but rather as dividends from joint ventures. So it's kind of a bit understated, the value of the work we do. So if you look at it in the round, it is a much improving sector.
But how quickly do you think you're capable of rebuilding margins?
So we've said that the whole group will get to greater than 8% in 3 to 5 years, and we're very confident in that ambition.
You've talked just now about this being a transformational set of results for you, the moment that you've got the balance sheet under control, and clearly you're committed to repaying dividends, resuming dividend payments in the near future. Do you have views on how capital is going to be allocated more broadly in future, for example, share buybacks perhaps?
So I think we have tremendous opportunities to create shareholder value through organic investment. We have plenty of opportunities around the world as people want to adapt to a rapidly changing world environment. So I think organic growth and generating shareholder value through that is top of our list. Paying a dividend is always important. It shows that you're a proper, well-founded company. I don't see share buybacks in the near term because I just think we have too many opportunities to invest in the company.
That was David Lockwood from Babcock speaking to me a little earlier, and I'll tell you later on in the programme how the share price has done. Very interesting movements this week. Some other stories for you now, though, in the meantime. And ministers have rejected pleas for financial support from a London-listed electric battery manufacturer, which faces collapse within days. Sky News has learned that efforts by AMTE Power to hold substantive discussions with Whitehall about emergency funding have stalled. AMTE Power has drawn up plans to build a gigafactory in Dundee, but has seen its valuation slump amid financing challenges. The news, of course, comes days after the government promised Tata when they reported £500 million worth of support to build car batteries to supply its Jaguar Land Rover unit. AMTE shares currently off some 14%. The UK borrowed less last month than expected, it emerged today. The Office for National Statistics said UK borrowing came in at £18.5 billion for June. That was significantly lower than the £22 billion that the market had been expecting and was down from £18.1 billion in June last year. It was, however, still the third highest June borrowing since monthly records began in 1993. It means that during the first 3 months of the year, UK borrowing came in at £54.4 billion. That was up £12.2 billion on the same period last year, but some £7.5 billion less than the Office for Budget Responsibility had forecast. Interest payments on the national debt during the month came in at £12.5 billion, which was the third highest on any single month on record. Fixed mortgage rates have risen again after a brief fall. The average two-year mortgage rate on the market edged back to 6.8% today from 6.79% yesterday, according to the latest market data from Moneyfacts. Five-year fixes have also risen slightly back to 6.32%, up from 6.31%. The online cosmetics and beauty retailer THG has sold its loss-making on-demand division to its management for an undisclosed sum. The sale, first reported last night by Sky's Mark Kleiman, includes Zavi, once one of Britain's best-known entertainment retailers, and I Want One of Those, the gifting website. The division also includes Pop in a Box, which sells fast-moving consumer goods. THG also announced it sold Pro Bike Kit, a specialist provider of cycling equipment, to Mike Ashley's Fraser's Group for £4 million. I can tell you the share price has done very little on that news. In fact, it's off 8.5% right now. Retail sales saw a boost in June, helped along by record temperatures. Retail sales volumes rose by 0.7% month on month, with the Office for National Statistics reporting increases in food, non-food and online retail. The biggest increase was in non-food sales volumes, which grew by 1% in June, following a fall of 0.5% in May, with summer sales boosting department stores and furniture retailers in particular. Food stores sales volumes bounced back with 0.7% growth in June, following a decline of 0.4% in May, when the extra bank holiday for the King's coronation boosted eating out and takeaways at the expense of the supermarkets. Now, after a bumper 2021, it's been a lean time for startups seeking investment from the venture capital sector over the last 18 months. But there are signs of renewed activity in certain sectors, among them early-stage companies in the SaaS, that's software as a service sector. But a new activity index produced by the investor Albion VC points to a big pickup in fundraising during the second half of the year. Well, joining me now to talk about this is Robert Whitney-Smith. He's a partner at Albion VC. Robert, welcome to you.
Thank you.
What does this index show?
So the index was inspired by the PMI index, and what it's trying to do, we were trying to help our founders by giving advice to them on the outlook for the market. And there's a lot of historic data available, and there's a lot of anecdotes, but we thought actually perhaps we can pull together through our network and create an index incorporating all the data, subjective and objective, as to the outlook going forward. And so we did that. We surveyed 40 of the main investors across the UK and Europe, who account for something like 2,600 portfolio of the fastest growing portfolio companies in software. And we found that H1 was indeed, as I found for myself in my 20 years as an investor, the quietest ever. But the outlook for H2 is strong and is much stronger. What we found was in H1, what happened was that the demand from investors was there, both the money and indeed the confidence, but actually the supply from software founders looking to raise was much lower. So it was on the supply side that was the issue.
Okay. Are you measuring actual sentiment here or actual deal flow, or a combination of the two?
Both. So we wanted to put as much fact and objectivity into it as possible. Some of the things we can do is ask both ourselves and other funds, how many term sheets have you issued? What have you got in your pipeline? And that gives you a pretty good sense of potential activity over the next quarter. And if I give up the example from our own fund, a typical year for us is 5 to 6 new deals. It was in 2020, 2021. It shot up in 2022 to 15 because there was an unusual market, but then 0 offers for new investment in the first 5 months to May. And that wasn't because of a shortage of potential opportunities. It was because of a shortage of potential opportunities. But since June, we've issued 6 offers for new investment.
So what's changed?
Great companies are coming looking for funding.
Right.
I can speculate as to why.
Well, I mean, yeah, is it because founders are getting nervous and they need more money?
No, I think our sense of so we've got 60 portfolio companies, and obviously we speak to other VCs. In aggregate, we're talking to 2,600 companies indirectly. And I think the message was in 2022 there was a panic. The markets changed dramatically. And then going into 2023, we had Silicon Valley Bank collapse in March, and then subsequently Credit Suisse. So I think there were a lot of reductions in force, and people were pressing the foot on the brake and extending whatever cash they had raised. They were spending it more carefully and looking for a longer runway before their next fundraising round. I think what's happened now is people are now more confident of growth. They can see the capital's there, which is very important, whether you're an existing founder or you're looking to found a business, be it an academic or an employee with a great idea.
And why the software as a service sector in particular? Why does that look quite busy?
There's been, it's an incredible sector for investors in terms of the business model, the recurring revenue, very high gross margins, scalability. With a limited amount of capital, you can create a very large outcome and have a huge impact. Sorry, the second part of the question?
Yeah, and I was going to say why SaaS in particular.
Yeah, so that's and then underlying that are the breakthroughs in technology and innovation, I think that you're seeing, popularised perhaps in the release of OpenAI's generative ChatGPT to the public, but everyone can now see what AI is capable of in terms of creativity, but there's also so much going on within predictive AI, etc., behind the scenes in the corporate world.
That makes sense. Look, before I let you go, Rob, while we've got you, the government's obviously trying to get pension funds to invest in start-up growth stage businesses right now. Yep. Do you worry that that's going to crowd out investors like you?
No, not in the slightest. There is a significant amount of overseas pension fund money in the UK already, and it always surprises me a bit. Well, it's fantastic, but that the US and Asian pension funds are investing in spin-outs from UK universities. But I think it's more than needed. There's no shortage of this country has no shortage of innovation that could raise capital and create good returns.
positive note on which to end. Robert, good to talk to you today. Thank you.
Thank you very much.
Now, after the pandemic, more than 500,000 workers dropped out of the jobs market, most of them aged 55 or over. But the latest employment data suggests that older workers are returning to the labour force, and increasingly businesses are looking age-aware accredited employer status, in which they commit to implementing age-inclusive policies. The latest is the insurer AXA UK, whose HR Chief Operating Officer, Emma Harvey, joins me now. Emma, good to see you this afternoon. What made you seek this accreditation?
So we know that the over 50 population is a really important talent source for us. We see that we're on the sort of brink of a mega trend where we're starting to have many more people in the over 50 age bracket, and the younger workforce is shrinking. So we know that as an employer that want to be able to really have a sustainable workforce, we've got to look at this population to be able to get the skills and the resources that we need as a business. So it's hugely important.
I mean, a quarter of your workforce, Emma, I think I'm right in saying, is already 50 or over, which sounds like you're already on the right track. Why did you feel that you needed to do more?
So, yeah, we've already got nearly a quarter, and I think that's consistent with the national statistic of the sort of 25% of the workforce.
Emma, can you hear me? Oh, dear. I do think we might have lost Emma Harvey in Bristol there. We'll try and get her back after... we're going to take a short break and we'll try and get Emma back. We'll put another... Oh, no, we're back. Another shilling in the metre. Emma, that's all right. We lost you for a moment, Emma. What I was going to say to you is, what sort of things have you been doing to encourage older workers to stay?
So we've done quite a number of things working with our partner 55 Redefined. We've been looking at how we recruit and attract staff. So looking at campaigns to attract older workers, thinking about how we put those campaigns in our employer branding to attract that workforce. We're looking at ways to retain our staff. So we have a number of policies around older workers. We're looking at menopause accreditation, which we got in 2022. We have quite a lot around flexible working policies in order to really reflect what these older workers need and how they would like to work with us moving forward. And we're also looking at retraining, reskilling, upskilling, so that we've got apprenticeship programs, technical training development in-house. So lots of activities, and it's really important that we continue to grow that. We're seeing an increase in our numbers and a reduction in the number of people leaving us at that age. So I think all those things are examples of how we are really trying to tap into this really crucial talent source.
Absolutely. I mean, what you mentioned there, what older workers look for in an employer. I mean, are they less high maintenance than the millennials and Gen Zs?
I think everyone has different needs at different stages of their life, and we try to be very inclusive. The older workers tend to look more for flexibility because they tend to be carers, both for children still or for parents, older dependents. So that's one of the areas we're trying to be different. We've also got to think about the fact that sometimes people do get iller as they get older, but in fact what we see is that people that are in the older age brackets are much more engaged, they're much more motivated, they really understand the business, and they're much more reliable actually. So I think it's different depending on what age group you are and what's important to you.
Yeah, what about reskilling? Is that an issue?
Yeah, absolutely. So we see a lot more roles now coming through with data, with digital. So we have to find ways and also automation of activities, the more admin tasks. So we need to look at ways to understand what would those future skills be, and therefore what do we need to do as a business now to be growing and retraining our staff. So, and people with in this age bracket really have the business experience, so much easier to retrain and reskill because they're keen to come in, they're keen to learn and to find different career paths maybe naturally, or just take a different path down what they want to do.
All right, Emma, got to leave it there, I'm afraid. Good that we caught up with you today. Thank you.
Thank you.
Still to come here on Business Live, I'm going to tell you what's been happening on the markets this Friday afternoon. Don't go away.
I'm Martha Kellner and I'm Sky's US correspondent based here in Los Angeles.
It's turning everybody into, a crazy, violent drug addict.
How are you feeling?
I am angry. Legal abortion! It is an anti-woman agenda.
2 women say that you paid for their abortions. Are you a hypocrite, sir? Will your candidates win?
I hope so. I think they will. I think they're great candidates.
I gotta be realistic. My sister's dead.
More than 4 weeks on, there's no murder weapon and no suspect. Are you going to catch this killer?
We are doing everything we can.
Ghislaine Maxwell has pleaded not guilty to all 6 charges against her. Mum, how are you feeling today?
Jeffrey said, you answer to Ghislaine, you just don't cross her.
We're so excited.
Severe nightmares of these people coming in and just taking me in the middle of the night.
I've watched as whole towns were torn apart by natural disaster.
I'm alive and I'm thankful for that, but there are a lot of people who aren't.
It's not the winds people fear most here, it's the water. We take you to the heart of the stories which shape our world. Do you truly believe what you're saying?
A lot of cases that I know are reported from Ukrainian missiles themselves.
Ambassador, with respect, I think that's preposterous.
The 5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. Fly Emirates, fly better.
Well, the oil price has been trading back above $80 a barrel as the drop in US inventories earlier this week continues to raise concerns about tightness in supply. A barrel of Brent crude is currently changing hands at $80.60 a barrel. That's up 1.25% on the session. On the equity markets, Europe's finished largely to the upside this Friday afternoon. Only the DAX in Germany in negative territory. Here in London, the FTSE 100 has also finished to the upside, up a 0.25% nearly. It's its best weekly gain for the FTSE in 4 months. The plant and tool rental group Ashtead was the leading blue chip gainer in percentage terms. Hargreaves Lansdown was also among leading blue chip gainers for a second day running after yesterday's upbeat trading statement, which has sparked some positive comment from the brokers, up more than 1.75% there. Outside the FTSE, Babcock, we were talking to the CEO earlier on, finished up nearly 4.5% there. That brings its gain on the week to nearly 25%. Over on Wall Street, the Nasdaq, the S&P 500 and the Dow are all trading higher. Talking points this afternoon, though, include American Express, which is off 3.5% after quarterly results came in below expectations. On the foreign exchange markets, well, the pound has been selling off since the benign inflation data on Wednesday, off 0.1% against the dollar, unchanged against the euro right now. That is it from me. I'm back again on Monday morning at 11:30. I hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Kamali Melbourne. Have a good weekend. Cheerio.
The 5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.